Hello everyone, and welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeeze setups. Today, we're putting a specific company under the microscope, one that's been flashing brightly on our screen due to some truly eye-popping cost-to-borrow figures and recent market volatility. We're talking about NCRA Inc., trading under the ticker NCRA. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's get straight into it. NCRA Inc., or NCRA, is officially categorized within the consumer defensive/packaged food sector, but their core business is quite unique. They're an acquisition-focused company providing land-based recirculating aquaculture system services for aquaculture projects. Think fish farming, selling aquatic products, and producing food products. With a market cap of just $1.01 million, NCRA is firmly in microcap territory, and it's been anything but quiet lately. Chart chart, NCRA 30-day price action. Looking at the charts, the last 5 days have been absolutely wild, with NCRA stock soaring an incredible 1465.35%. Over the last 30 days, it's up 605.80%. Today, however, we've seen a pullback of 13.61%. Volume-wise, today saw 441,634 shares traded, which is actually a fractional amount of its 30-day average volume of nearly 19.5 million shares. That massive drop in relative volume is something we'll want to keep in mind. Why is cost to borrow and why it matters? So, why are we talking about NCRA today? It all comes down to something called the cost to borrow, or CTB. For those new to short selling, when you want to bet against a stock, you borrow shares from a broker and sell them, hoping to buy them back later at a lower price. But borrowing those shares isn't free. You pay a fee typically expressed as an annualized percentage. This fee, the CTB, is essentially the interest rate on the shares you borrowed. A high CTB indicates that there's strong demand to short the stock, but also that there's limited supply of shares available to borrow, making it risky for short sellers. Why this stock is hard to borrow right now. Now, let's look at NCRA's specific numbers that caught our attention. The current cost to borrow for NCRA is a staggering 1093.1% annualized. Highlight CTB number that is an exceptionally high fee, and it's not just high, it's rapidly increasing. We've seen a momentum increase of 625 percentage points over just the last 5 trading days. What's more, the shares currently available to borrow are extremely scarce, only 15,000 shares. Considering NCRA has an estimated float of 5.3 million shares, having only 15,000 shares available to short creates a very tight market. These numbers of sky-high CTB, rapid CTB momentum, and critically low borrowable shares are exactly why NCRA popped up on our hard-to-borrow screener. Our internal composite squeeze score, which combines these factors with others like float size and technical setup, currently gives NCRA a score of 57.6 out of 100. Squeeze mechanics explained. So, what does it mean when a stock is hard to borrow with such a high CTB? It sets the stage for what's known as a short squeeze. Imagine short sellers are betting against NCRA, but the price starts to move up. Their losses mount. On top of that, they're paying over 1,000% interest annually just to hold their short positions. If there are very few shares left to borrow, and the price keeps climbing, short sellers might be forced to cover their positions. Covering means buying back the shares they initially sold to close out their bet. This forced buying creates upward pressure on the stock price, which can then trigger a chain reaction, forcing even more short sellers to cover, driving the price even higher in a rapid squeeze. It's important to remember, though, that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have incredibly strong conviction and are willing to pay a premium to stay short. Dilution risk check. Before getting too excited, we must always look at potential risks. For NCRA, our dilution risk check raised a red flag. Recent SEC filings show a registration statement specifically in SMINIS1, SMINIS3, or 424B within the last 90 days. In simple terms, this means the company has indicated an intent to potentially issue new shares in the market. Why is this a risk for a short squeeze? Dilution, or the issuing of new shares, increases the total number of shares outstanding. If a company issues new shares, it can provide more supply for short sellers to cover with, or even for new short positions to be opened without forcing significant upward price action. This can effectively neutralize or even negate a short squeeze thesis, even if the cost to borrow remains high. It also dilutes the value of existing shares. Recent reverse split watch. Adding another layer of complexity to NCRA's situation is a very recent corporate action. NCRA Inc. executed a 1-for-30 reverse stock split just 2 days ago, on July 7, 2026. A reverse split reduces the number of outstanding shares and proportionately increases the share price. For example, if you own 30 shares at $1 each, after a 1-for-30 split, you'd own 1 share at $30. While it doesn't change the total value of your holdings, it does reduce the number of shares available for trading. Historically, we've observed a pattern where many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split. This isn't a guarantee for NCRA, but it's a tendency seen in some names, and it adds another dynamic to watch in the coming weeks. Again, a quick reminder, important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you keep an eye on with NCRA? First, continue to monitor the cost to borrow and the availability of shares to short. Will that 15,000 share count shrink further? Second, watch the price action closely. While NCRA has seen a massive rally recently, today's 13.61% drop, coupled with the incredibly low relative volume, suggests that the explosive momentum might be taking a breather. For a squeeze to truly ignite, we typically need to see sustained high volume to force shots to cover. Finally, keep tabs on that dilution risk and any developments regarding the reverse split. The confluence of these factors makes NCRA a complex but interesting case study for understanding short squeeze mechanics. NCRA Inc. NCRA presents a fascinating setup with its astronomically high cost to borrow and extremely limited shares available for shorting. However, it's crucial to weigh this against the significant dilution risk flagged by recent SEC filings and the fresh reverse stock split, which could bring its own set of unpredictable volatility. Remember, understanding these dynamics is key to navigating the markets, but always do your own rigorous due diligence. If you found this breakdown helpful, please hit that like button, subscribe for more in-depth stock analysis, and let us know in the comments if you have any questions or other tickers you'd like us to cover. Thanks for watching, and we'll see you in the next one.